Hello everybody and welcome back. On this channel, I borrowed over $250,000 from my home equity line of credit, invested it, and show everybody how it's performing. The good and the bad. It's been 4 months since my last update and that time has not been kind. The market has taken a huge hit and on top of that, interest rates continue to increase. If you're wondering how this red market affected my portfolio, you've come to the right place. Let's get into it. Since November 2020, when vaccine news hit, the market had consistently increased month after month. With each passing day, the market was only going up, and everybody wondered how long this could last. 16 months. Turns out it could last 16 months. At my height in March 2022, I had $94,000 in gains, so close to a nice 100K milestone. But after March, the market fell and continued to fall with each following month. But just like how the market can't go up forever, it also can't go down forever. And we may be seeing the light at the end of the tunnel. July is the first month where I've been in the green. Or is it just a tease? We'll see. As of today, my portfolio is down around $40,000 from my height. But I'm not concerned at all. This is all part of investing. As Peter Lynch once said, you get recessions. You have stock market declines. If you don't understand that's going to happen, then you're not ready. You won't do well in the markets. Sometimes the markets go up, sometimes it's down. But over the long term, you'll have more ups than downs. And that is what builds wealth. Assuming you don't panic sell. So my market value has taken a big hit. But let's look at my dividends, which, in a nice contrast to my low market value, my dividends continue to come in each month and grow. This year alone, my holdings increased their dividends 17 times. Bank of Nova Scotia actually increased their dividends twice this year. So although the market is down, my dividends are not only unaffected, but doing better and better. Just to note though, FFN, one of my split shares, its price dropped below the NAV in June and July. When that happens, they don't pay a dividend for that month. Now that's unfortunate, but that is the risk with split shares. High yield and the possibility of not paying some months. We'll see how long this lasts and if buying into split shares was worth it or not. Now let's look at a summary of my performance. On a principal investment of $280K, my market value is $325,609. I received $272 from my taxes back in April. My gains are $45,900 or 19%. And I'm collecting a total of $1,787 per month. But remember, we're using my HELOC to invest, so I need to subtract the interest to get the total profit. And with interest rates rising, I'm paying more and more for the privilege of using my HELOC. In my last video, I was paying 3.4%, equal to $730 a month. Since then, there have been 2 increases, making my current interest rate 4.9%, and increasing the interest I'm paying by $276. I'm now paying $1,006 per month in interest. The difference nets me $780 per month in profit. And my HELOC is currently at a balance of $246,483. Now I'm not sure if I addressed this in any of my past videos, but each month I am paying some of the loan down. When my wife and I get paid from our day job, 15% is marked for investing. But really, we're putting that money on the HELOC. That 15% does cover the interest and more, and that more is going to lowering the principal. My plan going forward is to build up growth stocks in my TFSAs. In one TFSA, I'm buying Amazon, and in the other, I'm buying Apple. For my non-registered account, I did make a video stating that I was going to buy more TXF, and I did that for a few months. But since then, interest rates continue to rise. Now there are 2 things I could do to combat rising interest rates. 1. Reinvest into equities that have a high yield. Higher yield means more dividends each month, which is what I was doing with TXF. Or 2. Pay down the loan. The lower my loan gets, the less interest I pay. But there is also another big advantage. By paying down the HELOC, specifically the portion I use to invest in my TFSA, I will be increasing the available credit of my HELOC. Then, if at any time interest rates do fall back down, or I find a good deal, I could always take the amount I paid back out again. Only this time, I'll be able to claim the interest since it will be used in my non-registered account. Remember, I have about $126,000 of my HELOC in my TFSA, whose interest I can't claim. By paying down that portion, I'll be converting my TFSA HELOC portion, which I can't claim, to my non-registered portion, which I can claim. Reinvesting into high yield is good for the short term, but paying down the loan so that I'll be able to later claim the interest is best for long term. So that's what I'll be doing, paying down my HELOC with the dividends from my non-registered account. So there's my update. I'm still in the green by 19%, but more importantly, I'm still netting a great amount of dividends each month. And I'm confident my current plan going forward is the right move. If you'd like to keep updated on the status of this type of investing, please like and subscribe so you'll be notified when I post future videos. Thank you all very much for watching, and until next time.